Welcome to the Dealmaking with Laura DiFrancesco podcast. I'm Laura DiFrancesco, your host. We're talking all about mergers and acquisitions, buying and selling small businesses, as well as corporate law. We are taking our experience closing over $10 billion of transactions since founding Dean Street Law 5 years ago, and my experience being an M&A and corporate attorney for over a decade and making it accessible to you as an entrepreneur. I hope that this helps you in navigating the complex world of mergers and acquisitions. And also, we're always happy to be a resource for you here at Dean Street Law. You can always apply to work with us through our complimentary consultations linked in our show notes. And a huge shout out and thank you to everyone who's subscribed and left us a 5-star review. If you haven't yet, be sure to subscribe and also leave us a 5-star review. It's one of the best ways to support us as a small business. And also be sure to share with your friends and colleagues on social media, through text, email, or however is easiest. It means the world to us that you're supporting our content and helps us make more to support you in your journey. Welcome back to another episode of the Dealmaking with Laura DiFrancesco podcast. I'm your host, Laura DiFrancesco. This is my little minion / co-founder / puppy that makes everything better. This is Molly. I hope you can see her. She's just the sweetest ever. So she normally sits behind me for an episode, but apparently wants to start today. Woo! Is that right, Molly? But apparently she wants to start this episode right up close. Oh, and she's stealing my note cards. We just love the excitement and adventure at the office. We just had a tornado warning. Apparently the local schools are being dismissed. Molly's the center of attention and stealing my note cards. We've got everything going on here. So if you don't know me, I'm Laura DiFrancesco, founder of Dean Street Law. We've closed over $10 billion of transactions to date since founding Dean Street Law. We specialize in lower middle market mergers and acquisitions, helping buyers and sellers buy and sell small businesses. So today's episode we're really excited to chat about is all about how to prepare your small business for sale. I will say we have a lot of resources, and I'm also the founder of multiple other businesses. So in addition to Dean Street Law, I'm also the founder of Flourish Co-working Event Space. If you like our setup here, we're here at Flourish. We also have Ethereal Farms, a farm with Airbnbs next to my husband's winery and vineyard, as well as Laura DiFrancesco LLC, our educational platform with resources such as our upcoming masterclass, Optimize Your Business Exit. So optimizing the exit value of your business. So be sure to tune into that. That's going to be on our website, linked in our show notes. And I also have an upcoming book that you may not be interested in, but just in case you're planning on selling a business to go buy a business, it's called Entrepreneurship Through Acquisition, a legal guide to buying a small business. So if you're interested in learning more about buy-side, we have plenty of episodes here on the podcast, as well as the upcoming book. Now, with respect to the topic of the hour, which is how to prepare your business for sale, we have lots to chat about, and I'm really excited to get into this episode. Number one, why does preparation matter? Because ultimately, just like we talk about in the Optimize Your Exit Masterclass, ultimately your preparation will be a determining factor in the valuation of your business. If you think of just a simple example such as real estate, a turnkey piece of real estate is going to have a higher value than a piece of real estate, generally like apples to apples, is going to have a higher value than a piece of real estate that requires a lot of time and resources to get it up to speed, right? So that's called your multiple. When you're talking about business valuations are done a number of different ways, but the most common ways you see are a multiple of EBITDA, earnings before taxes, depreciation, and amortization, and a multiple of seller's discretionary earning. There's a lot of other formulations we can talk about, but those are probably the two most prominent ones that you see in small business sales. So when you're thinking about that multiple, it gets higher the more preparation that you do. That's essentially your price per square foot being higher in a piece of real estate that's ready to be turnkey versus your price per square foot in a piece of real estate that needs a lot of work. So that's your multiple. Your multiple is going to be driven by your preparation for the business sale. That's going to be a lot of things. Now, oftentimes buyers want an opportunity where they can add value. That's helpful for them because it gives them a lower entry price, makes it affordable for them, gives them some opportunity for growth they can feel confident in. So oftentimes buyers do want a business that might need a new website, or they're not on social media, or they don't have a lot of Google reviews, or whatever the case may be. Maybe it's a marketing improvement that the buyer sees an opportunity, or maybe there's opportunity in the growth of the business sector. Maybe there's tailwinds from industry influences. So those different aspects will also contribute to that multiple. But things that are within your control are how prepared you are for the sale of the business. And so that preparation will increase your multiple, will overall increase the business value. And ultimately, in addition to that value that you can command in the marketplace, it will help you get to closing at that value, and it will help you get to closing more quickly, more easily. It will reduce the likelihood that a deal falls through. The worst thing that can happen is you get a good value for the business, but then they go into due diligence and find that things don't quite add up. There's a lot of skeletons in the closet, things that need to be dusted off, cobwebs, and addressed in order to sell the business, in order to transfer the business. An example of this is a great company that a buyer I've been speaking to wants to purchase, but the business was owned by two operating partners, and one of the operating partners passed away, but there was a lot of issues with the transfer of ownership. There was actually buy rights that the other operator had and still has. There was no documentation around the transfer of interests from the prior operator that passed away to the heirs. They were collecting money, not doing anything. Basically, all of it was in contravention to their organizational documents. Organizational documents is a key area that we oftentimes see not be done in accordance with law, requirements, not be done in accordance with their own documentation. And those create issues that impede a business from being able to sell. So one thing is it's going to impact valuation. And then two, it's also going to impact the actual ability for you to transfer the business. And this has been holding up the transfer of the business for months and months now. And we have a seller that wants to sell and a buyer that wants to buy, but ultimately there's a whole lot that needs to be cleaned up before the parties are able to transfer the business. That's cost, that's expense, that's time, lost opportunity, so many things. So when we are thinking about optimizing your business for sale, when we're thinking about how to prepare your business for sale, that's why we care about this. The other element is timing. Now, if you're familiar with real estate, you know that the time of a sale is everything. You just need one person to buy a business, one person to sell a business, or one person to buy a piece of real estate and one person to sell a piece of real estate. They can agree to whatever terms they can, but when you think of timing, it can drastically impact opportunities, value. And so the longer that you have in terms of timing, the more flexible you have, the more negotiation leverage that you have. Because if you're under the wire to exit the business due to the finances of the business, or a life change that happened unexpectedly, or a health change that happened unexpectedly, all of those things put a lot more pressure on you to sell and sell quickly. And so you don't necessarily have time to garner the best price. So when you're thinking of selling your business, you want to start that process as soon as you can so that you have the luxury of time, which will increase your likelihood of obtaining the best sale price, rather than having to do it under the timer and really have to be in a crunch and just accept what terms come your way. That has a lot less negotiation power, and you lose that leverage that you have. Understanding market trends, whether it's a buyer's market or a seller's market, it's kind of a bit of both. Most people would call this right now, today, this is March of 2026, a seller's market. However, there's so much opportunity for buyers, and I'm seeing buyers get great deals on businesses, and there's so many businesses that need to transfer. Baby boomers are retiring, they're moving on. Sometimes their families are not interested in taking on the business or don't want the financial risk of taking on the business. So there's a lot of reasons why right now it's a seller's market, but I'm seeing the truth in the numbers show that it's pretty fairly balanced right now, buyers and sellers. But importantly, in just overall global economic timing, right? We saw the pandemic, we saw logistic implications of a new administration implementing tariffs and taxes, which impacted logistics and pricing and costs. All of those global geopolitical economic trends will all have an impact on the sale of your business, even a small business. With that said, let's talk about more of what you can control. You can control your preparation, how much time you give for your sale. You can hopefully also control to sell during a growth period rather than a decline phase. And this is really important because your valuation of your business is generally based on, especially in common financing, bank loans, SBA loans, in common investor terms, all of the valuation is going to generally be based for a small business, not like a unicorn, like Snapchat or something like that. It's going to be based on the last 3 years trailing financial statements. And so you would like to show upward trajectory growth of revenue, profits, EBITDA for the last 3 years. And when you're able to sell on that growth trajectory, there's high confidence that future performance of the business will model past performance of the business. If you're selling where you're up 1 year, down 1 year, up 1 year, you can certainly sell, but it's just not as optimized for exit value as if you're selling on a growth trajectory, particularly in the past 3 years. If there's explanations that you can have, such as, well, we had tariffs for a year unexpectedly and now we don't, and we're getting back to business, you may be able to weight those years differently. So oftentimes in that analysis evaluation, there's weights given to each of the past 3 years. If you have a really high growth year this year and then some growth the past years, you may try to get it underwritten for the buyer so that it's based mostly on the most recent year, because maybe there's fundamental changes that have affected that growth that you expect to continue. But ultimately, buyers are looking to see a positive growth trajectory and the ability to prove that will continue. That will optimize your value. If you're in a decline phase and that's happening, it's okay. You just want to start to think of, what can I do now to head that off, to turn it around, to address it? Do I need financing? Is there an interim loan I could get in order to stabilize the business before exiting, or is that too much risk? All things that we can talk about. Also things that you can talk about with your business broker. Those are all good opportunities to talk through how to optimize that exit value. Now, personal timing considerations, like I said, you want to make sure you're giving yourself plenty of time. If you want to retire in 3 years, know that it's going to take time to get your business ready for a sale, to list it for a sale, to attract the right buyer, to get to closing. Hopefully that first buyer that you want to get under LOI with has the wherewithal to get to closing, and they're able to get to closing without too much coming up in due diligence, especially financial due diligence that would be an issue. We're going to talk about legal and financial preparation in a second. So if you want to retire, if you want to move on to a new venture, give yourself ample time. That's really important. When it comes to navigating corporate law, entrepreneurship, and managing small businesses, experience matters. Dean Street Law is a boutique corporate firm specializing in mergers and acquisitions and additional focus in real estate, commercial transactions, finance, and corporate governance. With over $10 billion in deals closed, Dean Street Law has extensive experience representing hundreds of clients in thousands of transactions, from small businesses to Fortune 500 companies. Whether you need startup guidance or advice on closing multi-million or multi-billion-dollar deals, we're your trusted partner every step of the way. Visit deanstreetlaw.com in the show notes to schedule a complimentary consultation. Now, the next part is legal and financial preparation. We have a package that we work with sellers on preparing your business for sale to optimize the exit value. We will essentially do a mock due diligence with you where we will do an audit of the governance documents, material contracts, assignability, and change of control provisions. We just did an episode on that. We can link in the show notes, which talks about how important they are for the transferability of your business. Past litigation, loss runs with claims for insurance and everything like that. Understanding the different types of assets that you have and whether your business is necessarily or is set up well for an asset sale versus a stock sale. If you have licenses, the transferability of those licenses, basically doing all the different due diligence we would do on buy side or on sell side early so that we can prepare the business for sale so that you don't have all of these unexpected issues come up that will, one, impact your valuation, because if you market the business as we've already looked at the assignability, we've already addressed the corporate governance, it's all positioned for sale, that's going to garner you a higher multiple. But then also you're going to make sure that once you've negotiated that purchase price, that you're able to sustain it during due diligence. Because if a lot comes up in due diligence, kind of the same if a lot comes up when you're doing a purchase of real estate and you're doing inspections, a lot comes up, the buyer might ask for purchase price adjustments. Likewise, they might ask for purchase price adjustments in the due diligence phase of the sale of your business if a lot's coming up in due diligence that's impacting the transferability of the business or the value of the business. And then we're also going to work together on being able to resolve any issues that come up in those audits. So that's what we do from a legal audit preparation standpoint. We also help you prepare all the documentation. You're going to be astonished. It takes a certain amount of work and time and energy to operate the business. It takes a whole lot more energy and work, especially because it's novel, it's something new that you may not have done before. It's going to take even more to sell the business, to market the business, to gather up all your documentation. So even just from the fact that you're preparing all of this in a non-time sensitive stage before you're under LOI, there's cost of the deal, there's more material cost of the deal to both the buyer and the seller, where you're under the timeline of getting things underwritten, getting all the deal documents done. You've already got a lot more going on. It's a lot of pressure to put on the seller to compile all of their documents for due diligence, to have it be looked through, to go through the underwriting process. And especially if you're selling your business and you have not recently gone through an underwriting process, if you haven't gotten a loan in the last 10 years, honestly, in the last 5 years, you're going to be astonished how much the underwriting process has changed. I've worked with sellers that have no debt on the business, which is a great position to be in, but then it becomes a really stark surprise that people are asking for 3 years of taxes, 3 years of financial statements, all the contracts, loss runs, litigation history, all these things, right? It's a lot to ask for when someone's not used to producing that information for an underwriting process. So we do that sale prep, due diligence, audit, and work together through Dean Street Law. If you'd like to chat more about it, you can schedule a consultation call through the link in our bio. We're going to work on cleaning up your books, your tax records, determining whether you want to clean up any debt, particularly intercompany loans or loans from the founders of things like that. Sometimes if you have multiple businesses, there may be some overlap. We're currently working on a deal where we're sorting out some overlap between two businesses. One is being sold and one is being retained. They have some intercompany loans. They have benefits for employees of one company being paid by employees of another company. We're also working on another deal on the buy side where the purchases of one business are being run through the P&L of another business, and likewise, we're seeing invoices for things related to another business on this business. So you want to make sure you really start to straighten up those things from a financial and legal perspective so that the books are clean. One thing that we also talk about is the risk of add backs and how much personal expenses are being run through the business. Now, from a tax perspective, the more that you can run through the business, the more tax advantageous it is. And that's certainly not on it in and of itself an issue, but then it becomes justifying add backs and justifying valuation and saying, well, these aren't really expenses of the business, so they should be added back to make the business better financially because these aren't going to continue post-sale. And then preparing financial statements that buyers expect. We'll work with your accountants on talking through these types of things so that you can make sure your financial statements are clean to the best of your ability and you're preparing them well for the sale. We'll work with you if you have a broker or anything else about talking about valuation expectations and preparing for that. And then there may also be some internal planning that you want to do, whether it's with your employees or your family or your wealth advisor. If there is any internal transitions in the business that you want to make, getting on a manager to essentially backfill your position so that the business is able to run more without you, working on standard operating procedures to document what you know in the business but might not be documented. Or it might be checking out whether there's any managers who are interested in owning the business, or if there's someone in your family who's been working for the business, how we can support the transfer and transition of the business. So succession planning in the business is a really important component of preparing your business for sale. And we work with you, your wealth advisor, your CPA on those different components. The next element is operational preparation. We talked a little bit about reducing the dependency on the owner. So you may be an absentee owner, and that can mean so many different things depending on the business. And what's actually an absentee owner is oftentimes very different than what someone says is an absentee owner. There are certain owners that barely or rarely are in the office. Maybe they're managing, just looking over the expenses, managing things at a very high level. Maybe they're not doing things on a day-to-day, but ultimately everything that you're doing in the business as an owner does need to be replaced by either the buyer or management or a new role in the business, something like that. So the more that you're able to reduce the dependency on the owner in the business, the more marketable that the business becomes, the more turnkey it is, the higher multiple it's able to command. And then streamlining operations, documenting standard operating procedures, as well as strengthening customer and supplier relationships. So this is something that we always have very strategic conversation around, because ultimately customer and supplier relationships can be very challenging to bring into modern days. A lot of the times you have phenomenal businesses that might be all backed on handshakes, but that's really driven by the relationship with the seller, the name of the seller, the reputation of the seller. There's no documentation around terms or prices or anything like that. And so we want to think of how we could best transition those relationships and how we can best position them for sale. Sometimes it means documenting them via contracts. Sometimes that's just too aggressive of a strategy for the realistic relationship of the parties. Sometimes it's more just making introductions to the buyer once a sufficient transition has already been initiated. Once you're already under a purchase agreement, you would not make introductions to customers and suppliers unless there's a purchase agreement, maybe even some other elements to the business. But basically, like, every document is signed. You're just waiting to do these introductions to get to closing. You wouldn't do that just by signing an LOI. But we talk about how can we address those relationships. Does it make sense to have them documented through contracts? If you have existing contracts, do you have issues with assignability and change of control? We do that in our audit, and we just had a podcast episode on that as well. If you have existing contracts, are they actually current? Are they something that we need to get updated? Is it something that you could have a confidence letter that you provide that the supplier or the vendor signs? Or is it something that you just don't want to address at all? Because if you're not, as the owner, having a relationship with the customer and supplier, then ultimately maybe something you just decide isn't an issue and we don't want to address right now. So when you're able to address these underwriting issues, customer concentration. That's going to be another something that we're going to be talking about in operational preparation. The cycle of the business, if it's a cyclical business, we're going to be addressing those. Addressing those underwriting issues will help you achieve the highest exit value, addressing potential red flags that would become purchase price negotiations before it comes to the buyers. All of those are going to enable you to optimize your exit value. And we're also going to talk about diversifying revenue streams, like we talked about, making sure you don't have considerable customer concentration, improving systems, processes, potentially also marketing and marketability. So all of these are conversations we'll have in preparing your business for sale. Now, with that said, if you haven't done any of this and you're already marketing your business for sale, that is absolutely okay. We work in a very proactive manner at Dean Street Law to help you position yourself the best that you can wherever you are. If you're already under LOI, absolutely fine. We're going to do our best to prepare you for the due diligence process before it begins. We're going to help you identify things that might impact the transferability of the business. No matter where you get started, that's the best time to get started. If you have the luxury of time, getting started sooner rather than later will help improve your exit value. So those are a few things I wanted to chat through on today's episode. If you found it valuable, please be sure to leave us a 5-star review, share with friends, leave a comment, let us know what you'd like to address next on the Deal Making with Laura DiFrancesco podcast. Cheers and happy deal making. Thank you so much for joining us on this episode of the Deal Making with Laura DiFrancesco podcast. I hope you found today's discussion insightful and that it brought you one step closer to mastering the art of mergers and acquisitions. If you enjoyed this episode, please be sure to follow and subscribe to Deal Making with Laura DiFrancesco on your favorite podcast platform so you never miss an episode. And if you found value in our discussion, please leave a 5-star review. It would mean the world to us. And share this podcast with your network, friends, and colleagues. For more in-depth resources, be sure to visit our website, deanstreetlaw.com, where you can find articles, guides, and more information on our services. Don't forget to follow us on social media for the latest episodes, updates, tips, and exclusive content. You can find us on LinkedIn, Search Funder, at LMDFrancesco on X, and at Dean Street Law on Instagram. Join us on our next episode where we'll explore more deal-making insights. Cheers and happy deal-making.